Jonah's card got declined at a hotel checkout in March. Not because he was broke. His company was valued at $10 million that same month. He had a term sheet on his desk, an office with his name on the lease, 4 employees whose paychecks he personally signed off on, and $412 in his checking account. He wasn't lying when he told people he was doing well. He also wasn't lying when he told his wife they couldn't afford the trip. Both of those were true at the same time, and almost nobody who isn't a founder understands how that's possible. Here's the thing that makes this story land wrong for most people the first time they hear it. We're trained to think of wealth as one number. You're either rich or you're not. If your company is worth $10 million, you're a $10 million guy, and $10 million guys don't sweat a hotel bill. Except that's not how the number actually works, and once you see why, you'll start noticing this exact gap everywhere, in founders, in real estate investors, in anyone whose wealth got built on paper before it got built in a bank account. This isn't a video about founders being bad with money, and it's not a sad story either. Jonah's fine, by the way. We'll get back to him. What I actually want to walk through is the mechanical reason a company's valuation and a founder's actual spending power can be almost completely disconnected from each other. There are 3 pieces to this. What a valuation actually measures, where the cash physically goes instead of into a checking account, and why almost no founder will ever tell you the truth about it out loud. Let's take them one at a time. When someone says a company is worth $10 million, what they usually mean is that the last time somebody bought a piece of it, an investor in a funding round, they paid a price that implies the whole company would be worth that much if you sold all of it at once. That's it. That's the whole basis for the number. Nobody actually offered Jonah $10 million in cash for his company. An investor bought 8% of it for $800,000, and if you do the math on that percentage, the whole thing gets valued at $10 million on paper. That's a real transaction, and it's not fake. But it's also not the same thing as Jonah having $10 million sitting anywhere. Think about it like a house. If your neighbor's identical house just sold for $400,000, your house is worth roughly $400,000 too, on paper the next morning. You didn't get richer overnight in any way you can spend. You'd have to sell the house, actually find a buyer, actually close the deal before that number turns into money you can use. A startup valuation is the same idea, except the house is a liquid in a much deeper way. There's no open market of buyers checking listings for 8% of Jonah's company every day. The price only gets tested again the next time somebody decides to buy in, which might be 18 months away, might be never. So the first piece of the puzzle is this. The $10 million isn't money. It's a snapshot of what one small slice recently sold for, multiplied out to the whole. It's real information, but it is not liquidity, and liquidity is the only thing a hotel checkout counter actually cares about. Okay, so if the company raised $800,000 real dollars, where did that money go, if not into Jonah's pocket? This is the part that surprises people the most. That money goes into the company's bank account, not the founder's. It's earmarked, usually with investors watching closely, for things like hiring, product development, marketing, office space, the stuff that's supposed to make the company worth even more later. Jonah pays himself a salary out of that account, and for most early founders, that salary is deliberately, almost aggressively small. Some pay themselves less than their own employees make. It's not humility. It's math. Every dollar Jonah pays himself is a dollar that isn't going toward the thing investors actually gave him money to do, which is grow the company, not fund his lifestyle. There's a psychological trap hidden in here too, and it's worth naming directly. Founders get punished, socially and sometimes financially, for taking money out. Investors watch burn rate. Employees notice if the founder's suddenly driving something nicer. So even when Jonah could technically pay himself more, there's enormous pressure, external and self-imposed, to plow almost everything back into the business instead. He's not being reckless. He's playing a specific, brutal game where the reward for patience is a bigger number later and the penalty for taking money now is looking like you don't believe in your own company. And then there's the equity itself, sitting there completely frozen. Most startup equity comes with restrictions, vesting schedules, lockup periods, rules about when and how you're even allowed to sell your own shares. Jonah can't just decide one Tuesday to sell 2% of his company to cover a vacation. There's often no buyer waiting, no market to sell into, and even if there were, doing it would send a signal to everyone watching that he's losing confidence, which could tank the very valuation he's trying to cash in on. Here's the part that flips the story from inconvenient to actually risky. A lot of founders in Jonah's position don't just have less cash than people assume, they often have more debt than people assume too. To keep the lights on during a slow month, plenty of founders take out a business line of credit. Sounds fine, except banks routinely require a personal guarantee on that credit for an early-stage company, meaning if the business can't pay it back, Jonah personally can. His house, his personal savings, whatever he has, become collateral for a company loan, even though the whole appeal of building a company instead of working a job was supposedly limited personal risk. Some founders also borrow against their own equity directly. There's a whole quiet industry built around lending money to startup employees and founders using their illiquid shares as backing, which sounds clever until you remember that if the company's value drops, the loan doesn't shrink to match. The debt stays exactly the same size. Only the asset backing it gets smaller. So picture Jonah's actual financial position underneath the $10 million headline: modest salary, restricted equity he can't touch, and a small personal guarantee sitting quietly behind a business credit line he hopes he never has to think about again. On paper, he's worth 8 figures. In his actual bank account and his actual legal exposure, he's thinner and more exposed than plenty of his own employees, who at least get to walk away from their job with zero personal liability if the company fails. So why doesn't Jonah just explain all this the next time someone raises an eyebrow at him skipping a trip? Because it doesn't land well, and he knows it. Try saying out loud, "My company is worth $10 million, but I only have $400 to my name," to someone who isn't in this world, and watch their face. It sounds like either a humble brag or a lie, and there's no version of the sentence that comes out sounding like the boring accounting truth that it actually is. So founders learn to just not talk about it. They let people assume what they want to assume. If the assumption is, he's rich, that's actually useful. It helps with hiring, with credibility, with closing the next round. Correcting it costs him something and gains him nothing. There's a second reason, quieter than the first. Admitting the cash crunch, even truthfully, can look like admitting the business isn't doing well, even when the opposite is true. A company can be growing fast and burning cash on purpose precisely because it's succeeding and needs to keep feeding that growth. Jonah being broke personally can be a sign the company is working exactly as intended, but that nuance doesn't survive a casual conversation at a dinner party. "I can't afford it right now" becomes "business must be struggling," and that rumor is worse for him than just quietly turning down the vacation and letting people assume he's just busy. Here's where I want to complicate this a little, because it would be too easy to end on "poor, misunderstood founder" and call it a day. This gap is also, quietly, a strategy, not just an accident that happens to founders. Plenty of wealthy people, not just startup founders, deliberately keep their personal cash thin and their assets tied up in growing things, because in a lot of tax systems, unrealized gains, money you technically have but haven't cashed out, aren't taxed the same way actual income is. Being illiquid isn't purely a hardship story. For some people at Jonah's level and above, it's a genuinely chosen position because the alternative, pulling cash out, paying yourself a bigger salary, cashing out equity early, comes with real costs of its own, in taxes, in signaling, in giving up future upside. So the honest version of this story has two founders standing in the same spot for very different reasons. One is Jonah, genuinely cash-strapped, genuinely stretched thin, hoping the company clears the next milestone before something breaks. The other looks identical from the outside. Same declined card, same "we can't afford it right now," but is sitting on a deliberate, calculated bet that being thin on cash now is the correct trade for a much bigger number later. From a hotel checkout counter, you cannot tell these two people apart. That's exactly why the assumption $10 million means he's rich fails in both directions at once. It's wrong about Jonah's hardship, and it's wrong about the other guy's actual game. So what do you actually do with this if you're not a founder yourself? First, stop using someone's headline net worth as a stand-in for how much spending power they actually have, whether you're judging a friend, a business partner, or honestly yourself in a few years if you ever end up building something. Ask a different question instead. How much of what you own can you turn into cash this month without wrecking the thing that made you valuable in the first place? That number is almost always smaller and more honest than the headline figure. Second, if you're the one building something and you find yourself in Jonah's position, know that the discomfort isn't a sign you're doing it wrong. It's often a sign you're doing exactly what building a company from nothing actually requires. The mismatch between the number people see and the number in your account isn't a bug in the system. For better or worse, it basically is the system. Jonah ended up putting the hotel room on a personal credit card and paying it off over 2 months. His company closed its next funding round about a year later, and this time, some of that money actually was structured to reach his own account. He still doesn't tell people the full story. It doesn't fit in a sentence people believe the first time they hear it, which is sort of the whole point of this channel. Next video, we're taking apart another number that means something completely different than what it looks like. Subscribe if you want to be there for it.